Are we kind of in this still in the discovery phase? Have we seen much progress on the payment side? Where are the developments looking on kind of B2C merchant agentic commerce?
We're seeing some real progress in terms of protocol developments over the past few months that are really helping establish rules of the road for merchants, agents, and intermediaries. We're seeing the conditions for adoption of, the actual payment embedded in that agentic journey really coming into being. But I think that the other side of that is that volume is a long ways off. So the capabilities are here, but mainstream usage isn't.
Yeah, and I'll just build on the agentic conversation, but from the commercial side, the consumer side of agentic is exciting and gets the headlines, and as Justin mentioned, has made some solid progress. But another area where it's starting to grow is on the business side in finance back offices.
So obviously, tokenization is an important component of agentic because of the fact that, robots should not be running around with your full card details and free to use them as they see fit. We want to equip the robots with credentials that are permissioned, auditable, and tightly controlled.
Are we starting to see the fire, or is it still mostly smoke? How are we seeing some of the use cases emerge, and is it what we thought they would be?
There are stories here and there of stablecoins being used in niche use cases, but what we were describing earlier in the year does seem to still be the case in terms of low usage for real payments outside the crypto ecosystem. It's still the case that almost all stablecoin transactions are for moving money between crypto wallets of large institutional holders or exchanges, or for trading within decentralized finance applications, for instance.
You can't be a payment provider of any sort in the marketplace today without a stablecoin strategy. But to Ashley's point, we're still waiting for the real breakout use case. It's almost like it's at this stage, it's like as part of the feature set. We need to have it as part of what we do. We need to check the box for our investors, all that type of stuff. But we're really still waiting for that breakout use case. And we still might find it.
Where are we with tokenized deposits these days? Is it something that's kind of growing within the banking system as a reaction to stablecoins, and where do we see this kind of progressing?
There's a new article that came out in the Wall Street Journal just yesterday with another announcement with JP Morgan, Citibank, Wells Fargo, and Bank of America, where they're going to develop a private blockchain for tokenized deposits transfers between those financial institutions. The clearinghouse is involved with this. So this would allow kind of the benefits that you often hear about this digital currency, 24/7 transfers between these banks.
I know you've been poking around and digging into the stablecoin space and the instant payments world as well, and kind of merging those two worlds together. I'd love to hear your thoughts.
The point I find interesting too is how this sits next to the topic of instant payment systems. A lot of these new domestic systems are local currency rails built to strengthen the local currency and bring more people into the formal economy. A US dollar stablecoin is, pulling in a different direction toward holding and moving dollars, so the two can end up a bit in tension.
What's happening with kind of the Nexus implementation? Are we still waiting? How do we solve the cost problem? Anything notable that we can highlight here?
Two things I'll highlight. So one, in February, Indonesia became the 6th jurisdiction to join Nexus. They were actually previously an observer. Now they're actually a full participant. So just the interest in Nexus and what it can offer is growing. Also in February, another announcement was made, which is really an indication of kind of moving more into the implementation stage, is that the technical operator of Nexus, kind of what we call the platform, right? The technology, the operator was announced.
We can really think about the contribution of basically private blockchains or public ones to enable digital currencies to be transferred for cross-border payments from a couple perspectives here that can translate into lower end user costs. So really they're enabling a platform where money can move on this shared programmable environment.
Where do we kind of stand on that settlement now that we're kind of halfway through the year? Is it sticking around? Are we heading back to the drawing board? And where do we see it going forward for the rest of the year?
But I think the big so what here is, just that merchants are still pretty unhappy. And there's a real concern that capping interchange actually isn't enough to fix the issue of growing costs for total acceptance. The EU addresses full cost of acceptance. They've capped interchange and they've capped scheme fees. So I think that if this settlement sticks, but the scheme fees and total costs keep growing, I think there probably is going to be more pressure for broader regulatory action to address the full cost stack.
So I think the equal and opposite reaction of rising total costs for merchants is surcharging, right?
Month over month over month, you see increasing uses of surcharges. The thing I would note in the US that I see changing is you're seeing it more, you're seeing it starting to be incorporated as a feature inside of a lot of retail systems, so that instead of the small merchant sort of willy-nilly surcharging and not really understanding what the surcharging rules are, you're starting to see support for surcharging be formalized inside of a lot of software packages, which they're formalized in a way that is compliant with card network surcharging rules. So that kind of says that we're going to see more surcharging in the US, I think.
Give us some insight on kind of where we're at with overall global card fraud rates, and maybe just VAMP more generally.
Yeah, VAMP is where everyone's attention is. It's gotten more potent, not less, since January. VAMP is volume-based. That's the change that keeps catching merchants off guard. So every dispute and every fraud report counts equally, regardless of transaction size, which means high volume, high ticket count, low value merchants are particularly exposed.
Is the de novo trend playing out the way that Brian described, or does it still feel like the year of the regulator is behind us? Where do you see this world of chartering and the broader regulatory climate heading in the back half of the year?
Having more chartered banks lessens the dependency of sponsored banks in the long term, but I do believe there remains a significant opportunity for sponsored banks, particularly when serving earlier stage startups that prioritize rapid scaling and innovation. For these companies, obtaining a bank charter can introduce substantial regulatory and compliance obligations that may divert resources and attention away from their core growth objectives. In the later half of this year, I'm personally just watching the conditionally approved banks to see if they get their full charter and begin operating, and how they shift the market dynamics as we see them today. The Genius Act has a July 18th rulemaking deadline, which I infer will drive another wave of trust charter applications from stablecoin issuers who now have more regulatory clarity.